And that's why I'm saying if your entire strategy is based on what some blue tick account on Twitter said,
Right.
you haven't got an edge. You've got a hope. A very, very expensive hope.
Mate, you've just described 90% of the crypto market. All right, let's get into it then. The big one. Everyone and their dog bangs on about having a trading edge.
Yeah.
But if you ask them what it is, they just waffle. So let's break it down proper. How do you actually know if your edge is the real deal?
You're the one with the gray hairs, Morgan. You've been staring at charts since I was in nappies. You start. What even is a trading edge in plain English?
All right, you cheeky gip. Look, forget all the complicated stuff for a second. An edge is just a statistical advantage.
Okay.
It's not about winning every single trade. It's about this thing called positive expectancy. If you took the same type of trade 1,000 times, would you come out with more money than you started with? If the answer is yes, you might have an edge.
Might have, so it's not a guarantee.
Nothing's a guarantee. This is trading, not a savings account. But you can put a number on it. The formula is basically your win percentage times your average win
Right.
minus your loss percentage times your average loss.
Right.
If that number is positive, you're in business. If it's negative, you're just donating your money to the market.
See, that's interesting because in crypto, an edge often feels like just being, I don't know, faster than everyone else.
Yeah,
Getting the news, seeing the volume spike, it's a speed game.
that's a type of edge for sure, an informational one. But it's fragile. The minute everyone gets that info, your edge is gone.
Right.
A true, robust edge is usually a statistical one, based on some market inefficiency you can exploit over and over. It's the difference between a one-off heist and a business.
So all these Telegram groups selling guaranteed profit signals?
They're selling you a dream, mate. If their edge was so good, they wouldn't be selling it for 50 quid a month. They'd be on a yacht and telling you to get lost.
Okay, I'm with you. So let's say I've got a strategy. I've done the maths and it has positive expectancy. I'm ready to print money, yeah?
Hold your horses. I have seen strategies with 90% win rates go broke.
Incredulous. How is that even possible?
Because their one loss out of 10 is a catastrophic blow-up.
Wow.
It wipes out the 9 little wins and then some. This is why just looking at your win rate is a rookie move. You've got to look at the quality of your returns.
So what are we looking at? Give me the breakdown.
First up, the Sharpe ratio. All the hedge fund boys love this one. It's simple.
Okay.
Are you getting paid enough for the amount of risk you're taking? It measures your return against your volatility. A high Sharpe ratio means you're getting a smooth, steady ride.
Right.
A low one means you're on a violent roller coaster for pennies.
Right. In crypto, the volatility part of that equation is always massive. So getting a good Sharpe is tough. You're getting insane returns,
Exactly.
but the ride is pure chaos.
Exactly. Then there's my personal favorite, the Kalmar ratio. This one's for the realists. It measures your return against your maximum drawdown.
Drawdown. You mean the soul-crushing moment you look at your account and it's down like 50% from its peak?
That's the one. The Kalmar ratio is the ultimate sleep at night metric.
Right.
It asks, for the return I'm making, how much pain did I have to endure? If you've got a strategy with a high Kalmar, it means you're making good money without ever having a massive heart attack along the way.
A low-pain, high-gain strategy, the holy grail. And what else?
The most simple but powerful one, profit factor. Just take your total gross profits and divide them by your total gross losses.
Simple.
If it's 2, you're making 2 quid for every one you lose. If it's less than 1, turn off the computer and go for a walk because you're losing money.
I like that. No nonsense. So you're not just looking at if you're winning, but how you're winning. Is it a smooth ride or a car crash? Is the reward worth the pain?
That's it. It's about building something that can last.
Yeah.
Anyone can get lucky for a bit. Pros build strategies that survive.
All right, so my strategy has positive expectancy. My Sharpe is looking tasty. My Kalmar is decent. Now can I quit my day job?
Almost. But now comes the part that separates the men from the boys. This is the real high-level stuff
Okay.
that you test you on in the CMT Level 3 exams. You have to prove to yourself that you're not just fooling yourself.
What, you mean prove it's not all just a massive fluke?
Precisely. It's called statistical validation. You have a beautiful backtest that looks perfect on a chart,
But
was it just luck? Did that pattern only work because you got the perfect sequence of trades in that specific historical data?
so you're basically the prosecution and your trading strategy is on trial.
Perfect analogy. And your first piece of evidence is the p-value. In simple terms, it's the probability that your incredible results happened purely by random chance.
You want that p-value to be tiny.
Usually less than 0.05 or 5%. If it is, you can say your result is statistically significant. It's a stamp of approval that says, this is probably not complete nonsense.
So it's a check against your own ego. I like it.
It has to be. Next, you get to the really fun stuff. Monte Carlo simulations.
Sounds like something out of a Bond film.
It basically is. You tell a computer to create thousands of alternate realities for your strategy. It takes all your trades and shuffles them into a random order. What if your 10 biggest winners all came at the beginning?
Oh, wow.
What if your worst losing streak happened right at the start? It runs thousands of these scenarios.
And you're looking to see if your strategy still makes money on average, even when luck isn't on its side.
Spot on. You can also generate completely new synthetic price data and run your strategy on that. You're trying to break it. You're throwing every possible scenario at it.
Right.
If your strategy's equity curve still goes up and to the right across thousands of these brutal simulations, then you've got something seriously robust.
Amazing. Fam, that is next level. Most people in my world just find a pattern, backtest it over a few months,
Yeah.
and then ape in with their life saving.
And that's why most people get wrecked. This process is how you avoid data snooping bias. If you test 100 different stupid ideas, one of them is bound to look good on a backtest just by pure dumb luck.
Ah, okay.
Monte Carlo testing helps you figure out if you found a real edge or just the lucky one in 100.
It's the difference between being a scientist and being a gambler who found a lucky slot machine.
Couldn't have said it better myself. You use these tests not to prove you're right, but to honestly and brutally test if you might be wrong. That humility is what keeps you in the game.
Right. My head's spinning a bit, but that was solid gold. Let me see if I've got this straight. Step 1, find a potential edge and check for positive expectancy. Don't bother if it doesn't have it. Step 2, measure performance like a pro. Sharp ratio, Kalmar, profit factor. Step 3, try to destroy your own idea with p-values in Monte Carlo simulations to prove it wasn't just a lucky backtest.
That's the framework. It's not as sexy as a 100x call on a dog coin. I'll
Right.
give you that.
True.
But it's a process that actually works. And it will still be working in 10 years.
Yeah, probably better for your hairline and your heart rate in the long run. Quality stuff, mate.
Anytime. Now, are you going to finally run a Monte Carlo and that buy every time Elon tweets about Mars strategy of yours?
Nami, some things are sacred. The chaos is the edge.
I'm sure it is.
All right, listen up, you lot. We're out of time, but the conversation doesn't have to stop. We've got a chat group. The link's down below. Hop in, have a laugh with us, and tell us about the dodgy edges you've tried to trade. We promise we won't roast you too much.
We absolutely will.
Get in there. All right, we're out.